Hi guys, welcome to my channel. My name is Irene. Today, let's talk about bond, rates, commodity ETFs that we can add to our portfolio. Now let's do it. When we build our portfolio, we can think of ourselves as the fund managers picking assets to the mutual funds. If you ask them to build a diversified portfolio, they will look at the correlations among the different asset classes, which is the primary determinant for the portfolio risk. Lower correlation associated with lower risk. Unfortunately, most assets that we have on the market have high positive correlation. The large US company stocks on the New York Stock Exchange, Nasdaq, S&P 500 index, and the Dow all have correlations of zero point 0.9 plus, which is high. Correlation below 0.3 are considered attractive for portfolio diversification. So our challenge in diversifying risk in our own portfolio is to find assets that have correlations much lower than 0.9. Historically, some asset classes have shown low correlations in the past, such as the bond and the stock, or the stock and the commodities like gold. Let's firstly look at some bond ETFs that we can add to our portfolio. So, what is a bond? Essentially, it's a form of debt. The borrower pays interest periodically, which is called the coupon payments, and repays the principal on the maturity date. Bonds generally don't provide much capital gains. It's rather a secure, low risk, income generating security. For the bond issued by government, you can consider as risk free because it is backed by its tax power. But there are default risks among corporate bonds, and they are rated by the credit rating agencies. There are two different grades. One is the investment grade, and the other is speculative grade. Just be careful when you see the high yield corporate bonds because they are also called rubbish bonds by the financial professionals, meaning that it has high default risk. I will personally only look at the high quality bonds that are issued by Australian governments or the treasury corporations because the corporate bonds have high correlation to stocks, which is not very helpful. I got three bond ETFs for you to consider. They are GOVT, IGB, and VGB. In terms of asset under management, VGB has the most assets under management and IGB has the lowest management cost. In terms of the 3-year return, VGB outperformed the other two bond ETFs. In terms of the average maturity, VGB has the lowest average maturity. The shorter the average maturity is, the less opportunity cost for investors who is locked into the low interest bond ETF. And in terms of the average coupon rate, VGB still outperformed the other two bond ETF, and it has the highest liquidity in terms of the average trading volume. And both GOVT and VGB has more than 80% of holdings are AAA rated. We're in a low interest rate environment, and this might remain for quite some time. So it's good to have bond to complement our stock portfolio with the regular income stream as the form of coupon payments, just like a dividend stock. Now we're moving on to the alternative investment. And firstly, I'll talk about some property ETFs. Like fixed income asset class, real estate investment trust REITs can provide dividends as well as ownership of a wide variety of properties at a low entering cost. By law, REITs must pay 90% of their net earnings to shareholders, and they pay no corporate tax on the earnings that they pay out. Couple things to consider when you invest in REITs. REITs have mandates to focus on a particular sector. It's either a commercial or industrial or hospitality or retail. The state of the economy does have a big impact on the performance of REITs. Obviously, the current weak economy is not a good thing for REITs investment. And for Australia in particular, there are almost zero international travelers and the reduced international students for the rental property, restrictions on the retail business, the new norm of working from home are all negative factors to REITs investment. I got two ETFs that invest in REITs, which are MVA and VAP. MVA, the Van Eck Vectors Australian Property ETFs, it pays the dividend semi-annually, while VAP pays dividend quarterly. And MVA pays a slightly higher dividend. And in terms of management fee, VAP has a lower cost, and MVA outperform VAP in terms of the 3-year return. Now, let's move on to the next alternative investment, commodity. The most common commodity is gold. People buy gold to hedge the inflation, and gold being a commodity can be a good portfolio diversifier due to its low correlation to the stock market. One thing to keep in mind is that you want to make sure the underlying physical gold over ETF is allocated, meaning that you directly owning the physical gold, not the fund owning the gold on your behalf. So the gold ETFs that I'm going to compare are all allocated here. I've got two gold ETFs. One is ticker GOLD, the other is QAU. In terms of the fund size, gold has more asset under management and it has a lower management fee as well. I can't find any distribution information for the ETF gold, but QAU does pay annually on a 2.4% as the distribution. In terms of 3-year return, gold outperformed QAU about 3%. The bond, property, and commodity ETFs will complement equity ETFs that I mentioned in my last video. I'll link the video here and put it in the description box below as well. The weights of the different asset classes will depend on the purpose of the portfolio you want it to be. Either you're building a similar Ray Dalio's or weather portfolio, or you want it to be a more high yield growth portfolio. Is up to you. All right, that's the wrap for today. Hope you enjoyed the video and find some information that is useful to you. If you did enjoy watching the video, please don't forget to give it a like and subscribe my channel. I'll see you next week. Bye.